Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Rivian stock has been on an absolute tear over the past few months. Shares have more than doubled, as you can see here, and there seems to be a lot of optimism for both the economy and the growth of electric vehicles. But I think there are a few things to be worried about, so I want to highlight 3 red flags for Rivian that investors really need to think about. My name's Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you enjoy this video, check out my newsletter, Asymmetric Investing. Got a link to that in the show notes. I want to start with the first thing that is concerning, and this is really industry-wide. That is the pricing dynamic happening at Tesla. Now, Tesla has had to reduce their prices by nearly $10,000 per vehicle. That has put pressure on margins. Costs are starting to come down a little bit, but not nearly to the level that prices are. Now, Tesla is the only company that is at scale in the EV market, while companies like Rivian are starting to build out their scale. So it's really the only company where we can see how the supply and demand dynamics are playing out. And right now, it appears that Tesla has more supply than the market needs. To drum up demand, they have to lower prices. As Tesla ramps supply, expected to make over 50,000 vehicles this year, and I think they're on pace to do that. The question is there enough demand? And are they going to have to reduce prices? If Tesla is indeed the canary in the coal mine, then the answer to that would be yes. And that brings me to the second red flag. That is what's happening at Ford. You can see here that Ford has actually cut the prices of the F-150 Lightning electric vehicle by about $10,000. The entry-level truck will now start at $50,000. If we go to actually the Ford site, it lays out exactly how much these vehicles are starting at. You can see that the Pro model starts at $50,000 and goes all the way up to over $90,000 for the Platinum Edition. But as pricing becomes more and more important because of higher interest rates, because of more competition, this is going to be something that everybody's going to want to keep an eye on because there's a limited amount of demand right now for electric vehicles. So every increase in supply means that companies are fighting for the same customers. How much does it take to get into an R1T vehicle? Well, remember, $50,000 to get into a Ford. For an R1T, starting price $73,000. So more than $23,000 more just to buy an R1T. And keep in mind that this vehicle is a lot smaller than a traditional F-150, something that a lot of truck buyers are already comfortable with. So this is going to be a challenge for Rivian. How can you keep prices this high and have demand for not only the 50,000 vehicles that you can build this year, but increasing that to 100,000, maybe even 200,000 in 2024? I think that's going to be a huge challenge. Speaking of expanding demand, the third thing to keep an eye on is Rivian's expansion. A $5 billion expansion in Georgia was actually approved. Looks like this is going to be going forward as planned. And the goal here is to make less expensive vehicles on the R2 platform. Should be able to expand the market share. 400,000 vehicles is what the company is shooting for, up from the current facility, which can make about 150,000. There's supposedly some expansion that is possible there, but 400,000 vehicles at a little bit lower price point. Now, initially started production was going to be 24, but it looks like that's going to be pushed back probably until 2026. So Rivian is going to have to ramp up production at its current facility, make the R1 version of vehicles, and sell as many of those as they can while they're spending billions of dollars to build a second plant to build the R2 platform. What all of this means is that there's going to be a ton of cash burned over the next few years trying to get Rivian to a more steady state of operations. And if those first two things that I talked about, the pricing pressure and the potential demand pressure, really come to pass, it's going to make it harder to expand production into this R2 line. I think this is something the company has to do because it probably can't reach profitability with the first plan, but it's kind of backed into a corner where supply is increasing not only at Rivian, but at Tesla, at Ford, at General Motors. I don't know that there's going to be enough room for all of these automakers because the buyers for trucks and SUVs in the EV market are not increasing nearly as quickly as supply is. So I think this is a much more challenging business than the market is giving it credit for right now. The stock has run up really significantly, but operations don't look all that good. Not only at Rivian, but even at Tesla, who reported second quarter earnings already. Margins were down, and they're actually reducing production for the third quarter, which I don't think is a good sign. So a lot for investors to think about, but I think there's a lot less to like about Rivian now than there was even 6 or 9 months ago. So what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.